It's Ask the Tax Lady with Esther Gulius and E.G. Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hi, I'm Esther Gulius, the Tax Lady, and this is our hour to talk taxes. And every once in a while, what we do is instead of taking live phone calls, we kind of do topical issues and emails. So today, that's one of our plans today, that we're not going to be taking phone calls, but we will next Saturday take your phone calls. And of course, during the week, if you need us at EG Tax, you can call us at 632-7886, and we'll be very happy to help you. I'm Esther Gulius, the Tax Lady from EG Tax. I'm joined in studio here with Chris Fabian.
Hello, Esther. I thought you were going to say tropical questions, but then again, this is Buffalo,
Right.
not Hawaii.
Well, I mean, but we're happy. And Tiffany Fabian.
Hey there, Esther. How's it going?
Okay, and I'm good. I'm good. So this week is Taste of Buffalo. Not Taste of Buffalo. It's
an Italian festival.
Italian festival.
Right.
So there's nothing like Italian food.
Yeah, a couple of whiles ago we had the Taste of Buffalo. Oh, Italian food.
Italian
if
food
it's
is-
done right, oh, mamma mia.
Italian food is pretty darn good.
Oh,
I don't
yeah,
know.
yeah.
I've never really been to the Italian festival in about 5 years. Do they have anything besides like the sausage and onions? I mean, is there
Well, they
like
got the
yeah.
pasta, the raviolis. They got
Each restaurant sort of does their
Their own,
specialty and their own.
so really everybody could be listening
Pig out.
down by the Italian
Yeah,
festival.
Yes.
yeah,
So
yeah.
ciao bella.
All right.
But anyway, today we're going to talk about some topical issues, and we're going to do some emails. And at the first thing we want to talk about is there was a change this week in required minimum distributions on very specific plans, right?
well, really not a change, just an enforcement more so than because companies wanted to make changes, and the IRS said,
the
"Yeah,
brakes on.
no."
Or they
Okay,
put
so
the emergency
really,
brake on.
if you're in a defined benefit plan, like you work at General Motors and you're getting a pension,
Right.
X amount
New
of-
York State.
New York State pension, then they said that you have to follow the actuarial tables, and you can't divert from that. You can't
Correct.
take out extra money just because you control the plan. So that's a clarification this week. So if you're in a defined benefit plan, and you want to make sure if you are in a defined benefit plan and your company's been giving you more or changed it, that you want to make sure that they're giving you the correct amount, because it looks like the IRS is going to
Monitor
start
very
enforcing
closely.
it.
Right.
Did we ever figure out what the penalty was? Because we were
No.
looking at that.
No, because you never really could have taken more out, but doing some research, it was companies wanted to make changes to let people, once they started, take a lump sum to take their money out. And the IRS is saying, you can try whatever you want, but we're the bottom line, and we're
Okay.
saying no.
All right, and then the other thing is, last week there was a clarification on overtime eligibility. Now, if you're an employee, it hasn't come out in law yet, but I understand it's going to shortly. If you're an employer with a salaried employee who makes around $26,000 or less, they're eligible for overtime if they work overtime. Well, now they've changed that so that the employee, if they make less than, I think it was
54 or
54,000,
something.
if they make less than 54,000 and they're on salary, they're entitled to get overtime pay. So this is especially important for employers with people on salary. You want to make sure that you certainly don't want New York State wage
Knocking
an
on
hour
your door.
snooping around. So if you need any help and you are an employer and you want clarification on this about the changes in overtime eligibility pay, in other words, you got to pay your people more, you can call EG Tax during the week or visit us on our website at egtax.com, and we'll help you.
I can tell you, Chris has said I've heard him say to many employees, well, maybe you should make them salary. Maybe you should make them salary. And so really employers have to reconsider that.
Right. Well, the exception for management overtime is still in there.
Right.
It has to be a management position. So if you got somebody on salary and they're not in management, then the
And
overtime.
like a professional business doesn't fall into play. It's like McDonald's, Burger King.
Right.
This
And
small
I
business.
think that's really who they're
Targeting.
targeting, All right, so then let's see. The third thing was the penalty for health insurance assistance for employees. So again, if you're an employer and you with 50 or more full-time equivalent employees, and you didn't want to put into place an insurance plan, health insurance plan, well, then the penalty we know is
for that
$2,000
$2,000 for
per
the
employee.
year. Yep.
But if you are a sweetheart and you say, I'm not going to get you I'm not going to get you insurance, but what I'm going to do is I'm going to give you an extra couple $1,000s to help you pay for your health insurance, there's the rub. Because starting July 1st, a gigantic penalty just went into place for those employees, which is how much a day, Tiff?
It's $100 per employee per day, maximum $36,500 per year.
Per employee.
Per employee.
Wow.
Maximum $500,000 per business.
Oh, that's a lot of bread.
Yeah, totally. I mean,
So
I cancel the health insurance and pay the $2,000 penalty
Right.
per
Well,
employee.
they don't have health.
he's helping
Quit-
them.
Right, right,
quit-
yeah.
yeah.
He's helping
You
them.
absolutely, as an employer, cannot do this. You economically can't do this. So if you're somebody on the side giving your employees a little extra money to help pay for their health insurance because you don't want to do an insurance plan, get the insurance plan or pay the $2,000 penalty because you just have to do one or the other.
Don't keep
Right.
doing what you're doing.
Right. Don't
Yeah.
continue to do what you're doing, or you're going to have a big problem. So the other thing is, we're in the middle of the year, and if you're somebody that didn't get health insurance, remember the penalty for failure to get health insurance is 2% of your adjusted gross income.
That's right.
So if you make $100,000, your penalty is going to be $2,000. Now, part of what, and if you say, oh, well, I can't sign up now, that's not true, is it?
No,
Necessarily.
Tim made 3 appointments yesterday. Anyways, go on, Chris. I'm sorry I stepped on your feet.
If you have a life-changing event, you can still get health insurance. You lose your job, you can get health insurance.
Got divorced, got married.
Yep,
right?
a life-changing event, you can. If you were just lazy and didn't have health insurance, and now you say, "Oh, I should get health insurance," they're not going to let you for that.
Right. So, but many times when you look into people's lives, you find out that they did have a life-changing event.
Yeah.
Maybe they lost their job in February and they just didn't think they could afford it. Or how about somebody that's out there and they don't have a life-changing event, they just can't afford the health insurance because they're so poor, they could get Medicare.
Yeah.
Right?
And how about this? Yesterday, I was on the phone with a mom, and she retired, and so her kid won't be able to get health insurance through her anymore. Does this sound eligible? And so the kid needs insurance, and so he
Right.
made an appointment.
So he changed, his age changed, right?
Right,
He's
right.
over the age of 25,
Right. That's right.
So, so there's all these things, and part of what EG Tax does is we have a navigator. Right?
Yes, Tim.
Explain what a navigator, guy with the telescope and a
Map.
ship, right?
Yes. He licensed through New York State, and he can facilitate through the marketplace to get you health insurance. Go through, tell you the best options and what the price would be and how much of a
Now, is
subsidy.
he selling it?
He is not selling
He's
it.
just assisting.
He's just
and there's
assisting.
no money that EG Tax gets
Nope.
for Tim being a navigator.
Nope.
This is just a public service that EG Tax offers. And I will tell you, I had a client the other day that said, well, why would you guys want to do that? And I said, would you like to be the bearer of bad news? I don't want to be the person that says to somebody, oh, well, you have a $2,000 penalty because you didn't have health insurance. Because you want to be an advocate. At least now we can say, well, we were here all year long to help you.
That's right.
And we do want to help you.
Yeah. And the nice thing is during tax season, I can't tell you how many people I says you have the penalty, but we've got Tim. And so here's his number. Make an appointment. Don't let this happen again.
Right.
Yeah.
Okay, so let's talk about some other money issues before we get to the emails. They're starting this fall. They're proposing major changes to Social Security. It was reported by Crux, but I also looked at the Social Security website. And for those of you that have a computer, if you take a look at socialsecurity.gov, I think it's .gov. You can look at what Social Security is actually saying. They're looking at major changes. It's called Vision 2025. And so what the Social Security Administration is looking at is closing pretty much most of their branch offices.
Wow.
And making it more of a
Automated.
a virtual system. Now, if you're a senior, my husband, I guess we're both seniors, but I mean, like, my husband is really a senior, and you know, what they're doing is, if you're a senior, you got to start using Social Security on a virtual system. And what we're going to do is we're going to talk about that on the other side. We're going to break for a short commercial break. We'll be right back on the other side and tell you what's going to happen to your Social Security. Hi, this is Esther Golias, the Tax Lady. Thanks for joining us. This is Ask the Tax Lady. We're not taking live phone calls this week. We're kind of talking about some topical issues. And just before the commercial break, we told you that we're going to tell you about some of the changes to Social Security. And if you're a senior, you should be very keenly aware of these changes. First of all, I think there was something that was sent this week to President Obama from the Democrats, who want to overhaul the Social Security system, as well as the Republicans, because Social Security really is pretty much in trouble. Yeah, but then Vision 2025, if you look at the Social Security website, you're going to see that they're going to be starting to close. They're going to let much, if not most, of their staff retire, and it's going to become virtual, which means that you need a computer to communicate with Social Security. Now, part of what we do at EG Tax is, I think really the most disenfranchised group of people in the United States are seniors, because they don't know how to use the computer.
Technology.
And so, technology. So what they do is they think that they're going to use the telephone. They're not going to answer the phone. Those of you that have tried to get a hold of the Internal Revenue Service, they just don't answer the phone anymore. And they basically refer you back to the law that's on the website. Now, the other day, Chris and I were just reading something, a change in the tax law, out loud together. You have to read it out loud together, because it's all written in legalese, and it makes it very confusing.
Oh, it does. It does. And you have to, keep saying, refer to section 104.3, subparagraph A in number 4-B, who could also refer you to, and you're like so confused, right. You don't know where to go.
But I think part of where you're going, Esther, and correct me if I'm wrong, is that we help people with FAFSA forms. We help people with their STAR program. If you need help navigating the internet, and so when you're navigating through Social Security, it's a service we could offer.
I think a lot of seniors,
Yeah.
I think they don't even try.
Right.
And I will tell you, if you're planning on living, and I'm going to tell you the technology is changing so rapidly, I really think that we were thinking about doing like a seminar
office.
to help people to learn how to navigate through the internet, because it is absolutely remarkable. Am I wrong? The internet is remarkable. There's nothing that anybody can. The other day we came back from the Rolling Stones concert, which was remarkable. But I'm coming back, and I had my smartphone, and I remembered that Mick Jagger's girlfriend had just passed away, and so I Googled that. I read all about how she had committed suicide in March, how he canceled everything. I mean, you can be really a gigantically smart person if you know how to use the internet. And really what I guess I'm getting at is, with Vision 2025, with Social Security and your Lifeline, you're almost forced to either hire somebody to help you to navigate the internet for you, or you should learn it yourself.
Right.
And if I got enough people that were interested, we would do a little seminar. You could get I'll tell you, one of the easiest things to use, wouldn't you think, is an iPad?
Yep.
Yeah.
Oh, definitely. Yeah. Definitely.
I mean, an iPad, you're just using your finger.
Yeah.
Right? And it's $450 or $4.99 to buy an iPad. Go down to Walmart.
You could get a different tablet that's not an iPad.
Right. And I know it sounds foreign. You think, oh my gosh, I don't want, but I'm going to tell you, it's so easy. It's about the size of a little book.
Right.
And if everybody just brought their iPad, we'd show them how to use it.
Yeah. Well, and another really important thing is I remember when a relative of mine got an iPad, and you can actually go to Apple too, and they have classes on how to use it because.
But it's online.
No,
Isn't it?
Candy, I think, went to a live class. But part of where I'm going with this is you want to make sure that you're careful because there's identity theft. And so you want to make sure that you know all the ins and outs of using the internet.
Well, you see, then that's exactly what happens is then the senior says, well, that's it for me. I'm not going to do it.
Right.
And but I'm going to tell you, with
have
Social
to.
Security closing the IRS is not is just not going to be like the old IRS.
New
It's
York
just
State
not.
has no
New York
walk-in
State, right?
clinics.
Oh.
No. And then the other thing is buried in the 2016 budget that Obama just did is reductions to Social Security. And these are all things you can look online and read. And, if you need any help, EG Tax, we're thinking about doing some seminars. And I guess what I'd need from you is if you're listening and you think that maybe you'd be interested, give us a call at 632-7886, and we'd be very happy to. I think what the homework would everybody have to come in with an iPad. You'd have to
Some
bring an
type of,
iPad. You'd have to bring an iPad or some kind of a laptop computer, and we could just sit there and show you how to navigate. And don't be intimidated by
I want to
it.
be devil's advocate. There's also another one of my clients. She's about 94, and she had her identity theft stolen last year, and she has never been on the internet. So people can get your Social Security
that's for
number
sure.
from a whole host
And
of
LifeLock
reasons.
is a really good,
Right.
a really good organization.
Yeah.
So Social Security in the 2016 budget that Obama just did, so there are cuts in there, and Social Security is going to be closing field offices. They're
They
going
have to
to
save
virtual offices, and for those of you that are non-electronic, virtual means no human being helps you. You have to help yourself. My mother used to say, God helps those who help themselves. Well, I'm going to tell you, that's kind of where it's going to be. But EG Tax will help you. I just want to let you know. And again, if you think you'd be interested in a class, give us a call at 632-7886, and we'll be very happy to do that. Okay?
Yep.
And, okay, so should we do an email before we break for news?
Yep, I think that's a good idea. I've got Linda. She says, EG Tax, I'm so confused. I have a job making $28,000. I'm 62 years old. Can I start Social Security or not? When don't I have to pay back money? Is there ever a time when I don't have to pay taxes on my Social Security?
Okay.
Very good question.
So this is very confusing because until your normal retirement age, which would be 66, right?
Right.
Until your normal retirement age, if you make more than like almost 15,000, I think it's 14,700 some odd dollars in wages, then for every dollar over that figure, you have to pay back Social Security 50 cents.
Every $2 over, you pay
Right.
back $1,
Thank
or
you,
$1,
Chris,
you pay
you're
back
right.
50
That's
cents.
a better way to put it. And so there comes a place where she's making 28,000, which is about 15,000 over.
13, yeah,
Yeah.
so about
13,
60.
So she'd
would-
have to pay back
$13,000.
$6,000 or $7,000
Mm-hmm.
if she started collecting now. And so she might at this level, she just might want to wait until she's normal retirement age, which will give her a boost in the amount she collects per month. But she really has to put a pencil to it because.
And she's got to ask questions. I mean, maybe her employer is ready to. She has a pension plan. I mean, there's not a lot of them out there, but maybe she's working at an employer who has a pension plan, or she could go part-time at work.
Well, I mean, if she's looking at retiring and she wants to step back, maybe she's working almost full time at 28,000,
Right.
and she wants to work part time,
Right.
and she makes 15,000, then she can collect her Social Security. So yes, she can now. But if she does and she's single, then she will pay income tax. So paying back is if you make more than that threshold in wages until you're 66. So taxability is another issue.
Right, they're apples and oranges.
Right.
And a lot of people get that confused. Payback is between 62, 65. paying tax on your Social Security starts as soon as you start receiving it, which could be, if you're on Social Security disability, could be when you're 25.
That's true.
So
if your income is high enough.
yes.
So half of your Social Security added to your other sources of income. If you're single, the excess over 25 is half taxable, and that goes up until it's 85% taxable. So and what I'd suggest is it's so confusing. Why don't you call us at 632-7886 anytime Monday through Friday, 9 to 5 during the off season, and we'll be very happy to help you.
And
with that.
it doesn't. Okay.
All right. Anyway, I'm Esther Gullius, the tax lady from EG Tax. We're going to take a break for the news. We'll see you on the other side. Esther Gullius, the tax lady from EG Tax. This week we're answering email, so we're not taking live phone-ins. I got Chris Fabian, Tiffany Fabian here in studio with me, and we were just talking before the news about taxability of Social Security. And again, we'd like to invite you, if you have any questions about your Social Security, we'll explain when you have to pay it back, how much you can earn, how much of it's taxable, when it's taxable. And of course, one thing we always tell seniors, if you're on Social Security, watch when you have gambling income, because you can inadvertently make it 85% taxable by getting gambling income.
Yeah, and then I'd also just want to put out there, Linda, there's a lot of questions, and one of the questions is, are you married? Because it also is depends on how much your spouse makes too, the taxability of your Social Security.
That's true, and then the threshold is $32,000 up from 25.
Yep.
So do you think Mick Jagger collects Social Security?
He should.
He should. He's old, but boy, if I can move like him at 73.
Oh my gosh! I'll tell you, it was interesting. We were talking to Debbie Mariacker just before the show here, and she's at BEN, and I told her it was like going to watch the pyramids. I mean, there's such
15 shows.
I mean, they are rock and roll.
Oh. I'm
telling my husband he's got to start skipping like Mick
Jagger. Yeah. He did phenomenal.
It was phenomenal.
My jaw was on the ground. I had to scoop it up a few times. It was just remarkable.
They did a great show. Okay, what other emails do we have?
I got Charles. He says, EG Tax, I'm in big debt and I need to take $40,000 out of my pension plan. How much shall I have withheld from the check, and is it going to be penalized? I'm 50 years old.
Okay. We see this all the time.
Yeah, we do. So the truth is, I can start, and maybe Chris or Esther could pick up. If you're under the age of 59 and a half, there will be a penalty. It's early withdrawal penalty of 10% plus the tax you pay on it for the federal, plus the tax you pay on it for the state. And so I just want to chime in there really quick and say maybe you could get a loan, but what else would you like to add, Chris?
Yeah, because just the penalty alone, you're looking for $4,000. If you're in the 15% bracket, you're looking another $6,000. So you're looking $10,000 to the federal, 6% to the state, so you're looking $2,400 to the state. So you're looking about $12,400.
Depending upon if he has other income.
If
he has other income, he could pay 8% to the state. So I'm thinking here, you're looking at about a $17,000 tax bill, federal and state, on the $40,000. That is a lot of money. It's like 43% out the window. Yeah. All right. Well, the first thing I think you need to do is, when we're doing taxes, certainly taxes are important, but more than anything, your overall financial picture is where you should make your decision, right? I mean, you don't do things just to save taxes. First of all, if you have $40,000 in debt, I would say to you, you must probably have pretty tight credit or bad credit, or because if you're having that kind of credit card debt, maybe your credit is not so good. If your credit is not so good, maybe what you want to consider is thinking about a bankruptcy, because under bankruptcy laws, your pension is protected, because that's so holy, because someday you're going to need that money. And in a bankruptcy, they won't even look at your pension money. It's protected. And many people say, well, I don't want to go bankrupt. I'm not saying you would want to go bankrupt, but bankruptcy laws are there to protect you. So maybe, Charles, in this situation, your credit is already bad, and a bankruptcy would keep your $40,000 intact, and you might have to do a bankruptcy where you pay back a little per month, and your $40,000 would still be intact. The minute you go bankrupt, you can't go bankrupt again for I think 7 or 8 years again. So your credit can be rebuilt, and so it's like a win-win. It's in there for bankruptcy protection, and that's the first thing I would think of. Secondly, Tiffany, you said maybe you could borrow.
Right. And I just have to jump off what you said right there. Your pension is so holy. When you say that, it just puts it into perspective. It just puts it into perspective.
If you're not going to die, you're going to get old, and
right.
if you get old, you're going to wish you had a pension.
Right. And so going off what you said, you could go to your employer and see from your 401k if they would allow a loan. And a lot of my clients have that, and that's where they would loan you part of your pension, and then out of your paycheck every week or biweekly, they would take out so much to start paying back the loan. And as long as you are current and you don't default on it, you never get a 1099-R, and it's not something that's a taxable event, which is
and
here's
the other thing. On his 40, after he pays the taxes, all he's going to end up is with $26,000, right?
Yep.
So that's really all you need to borrow.
Yeah.
Right?
Very
so
eloquent.
you don't need to take out the 40 because you're only going to have 26
that's
left.
Right. That's
so
right.
just borrow the 26 and you're paying yourself back. Right? And so you still have the money. Then people say to me, but what if I can't make the payment? At any point in time, let's say you default in 3 years. Then you might only owe 15.
Right.
And now only that's subject to penalty. So, unless you really, 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 really have no other way to get this money, and you really, really, really have to pay off these credit cards, I'm going to tell you, I would first I pull my credit report. If I have credit not so hot, I definitely talk to a bankruptcy attorney. Dennis Kitchen does those all the time.
I mean, Tiff was saying a home equity loan. How about even, you call your credit card company and say,
negotiate
it. I owe you $8,000. Can I give you $3,000?
Well, where's he going to get the $3,000 from?
But it's
from borrowing the money.
But from borrowing the money,
right.
It would be less money you would have to borrow.
That's exactly that's right. So Charles, you could sit down, call your credit card company, find out how much they'll take on a negotiation. Maybe instead of owing, maybe you won't owe 40, maybe you owe 25. So then on the 25, that's all you'd have to borrow.
And if he's insolvent,
it's tax-free.
Then it would be tax-free because cancellation of debt, you would get the 1099, which relates to Claudette's question from Niagara Falls.
What do we got from her?
Before I forget, don't forget the option of asking mom or dad or relatives to borrow the money. Just want to put that out there.
But don't come and talk to me if Charles is my kid.
But it says, Claudette wrote in, I just got a bill from the IRS. They say I didn't claim money I got from a credit card settlement in 2013. I never got the money. What do I do now?
Okay.
So this is what we were
really
just
good.
talking about. Was she said, I'll give you $3,000 out of my $10,000 I owe you. So she got a 1099-C for $7,000
from her credit card.
From her credit card
for settling the debt.
Yep. She never got the $7,000, but she didn't have to pay it back.
Right.
So that $7,000 counts as income on her tax return. Maybe.
And what's the maybe?
If she was insolvent, meaning her income is way down here.
No, her assets.
Her assets
are low.
Yeah.
And her debt is higher than her assets.
Yep.
Right? And for the amount of the insolvency, that's how much you can make tax-free. Yep. So, Claudette, let's say that your assets, your total assets in this world, your car and your jewelry and everything comes to $8,000. But your credit card debt might have been $30,000. So really, you're insolvent between the $8,000 and the $30,000. So if there was $10,000 in credit cards that they let you go, let's see, she said it was how much?
It didn't say.
No.
But then you would be insolvent, and so there's a special form you can fill out,
a 982,
and you basically send that into the IRS with that bill. And if you need help, you can come to EG Tax. We'll be very happy to help you with
this
it.
Makes me think, I had a client yesterday, and she is disabled, and so there's something under the new guidelines for student loan interest, and so she can have all of her student loan interest forgiven. It was $90,000, and so her and I, her and I punched in what will happen with the 1098-C, and she just about hit the roof. I mean, she
must be insolvent.
I talked to her about that, and she said she's not insolvent. Her and her husband are absolutely not insolvent. She said that's not an option.
Well, then it's going to be taxable. But I will tell you, I would rather pay $12,000 in taxes than $90,000 in student loan interest. Right. At least it's dead.
Right. That's what I was telling her. But she says, "Oh, I'm not going to do this now."
What?
But, she's not thinking correctly. She's got to sleep on it.
Well, that's what a lot of people. We talked paying off the debt. I had a client. They wanted to take out $200,000 from a pension plan to pay off all their debt because the wife was losing her job. And I'm like, you're crazy. You're losing half of it because of your income.
Right.
You're going to lose half because in federal income tax, state income tax, the penalty, plus the extra Medicare tax that it was going to cause on their tax return. Right. They were going to lose half of it. And any other way, just don't do this. Well, nope, this is what we're going to do.
Well, I mean, you can lead a horse to water, but you can't make them drink. Yeah. But part of what we do at EG Tax is that we sit there and we will be your devil's advocate. We're going to give you another way to think about it. And sometimes you can just see the little light bulbs go off in people's heads because they say, I never thought of it that way. See, now, if that couple dealt with their debt another way, they'd still have their $200,000.
Yeah.
You know?
Oh, yeah. It's remarkable. And people ask us, why do you sit down and talk to us like this? Well, it's your money. It's your taxes.
And we have the knowledge.
And we have the knowledge. You should know.
Right.
What's the best course of action.
Right. And that's getting back to what we were saying at the beginning of the show. With technology, more and more onus is being laid on the individual who has to do the research. And so people know just enough to make it bad for themselves, because some of the exceptions to the law are really, and how all the angles work, that's really what makes everything so valuable. Knowledge really is
the key.
Is so important. Okay, let's see if we can do a quick one before the next break.
We have Matthew writes in, I want to give a large gift to my kids. 60-inch TV? No. Just how much can I give them in 1 year?
And so the answer is you can gift up to $14,000 per person per year without having to do a gift tax return. And so a large gift to my kids. So you'd want to look at how many kids he has, and you'd want to times that 14,000 times how many kids he has, and that's how much he can give each year. Of course, he can give more, but anything beyond that 14,000 would mean that he'd have to do a gift tax return.
Right, and that's really what you have to look at. It's just doing a gift tax return.
Right.
I mean, it's going to adjust the unified exclusion when you do the gift tax upon your death. So if you're not going to have an estate of over $5 million, you're never going to pay the taxes on it anyway. So. It's just deciding whether or not you want to do that little teeny gift tax return. You can actually give your kids $100,000 if you want, but you're going to do a gift tax return. You're not going to pay taxes. You're just going to do the stupid tax return.
Right. Now, if Matthew's married, then they could do a combined gift, and it would be $28,000 to each child.
And I get so many
or a spouse,
taxpayers.
because they could give it to their spouse too.
Right.
The others,
and
their
they could
kid's
give it to
spouse
their kids too.
and their grandchildren.
Right.
So.
Yeah. I have so many taxpayers who say, but if I give my kids money, does that mean they have to pay tax on it? And so the answer is no.
And for your information, it's not deductible either, because a lot of times parents think, I'm going to give the money and it's going to be tax deductible. It isn't. I'm Esther Gulius, the tax lady from EG Tax. We're not taking calls today. We're answering your emails. We're going to break for a short commercial break. We'll be right back. Okay, we're back to the break. I'm Esther And we were just talking about gifting and gift taxes. The other thing I wanted to mention before we go on to another email is that if the gift you give, and let's say it's 3 years before you go into a nursing home, there is a 5-year look back, and so you have to, your children have to be aware of the fact that if you gave away your estate prior to going into a nursing home, there could be a look back that they would come back and ask the kids for the money
to pay for the nursing
Right.
home up until
Right.
that gift is used up. Yep.
Okay.
Right.
So in other words, Medicaid will not pick up the tab.
And we're talking about gifts. Let's talk about basis. Right now we just talked about cash. Cash is cash, dollar for dollar. But what if mom gave the house to their daughter, or Larry or Matthew gave stock to their son? What's the basis on a gift?
That's really important before you go ahead and give some capital asset away. It's important that you determine what your basis is, because if you really gift it away, then the basis becomes, when they go to sell the asset, what you paid for it plus reinvested dividends, or if it's your house, what you paid for it plus improvements. Now, if you do a life estate, that's a horse of a different color, right?
Right.
On a house.
Yep, you got to be really careful. Got to get the advice. Call us. Call somebody that knows what they're doing.
Yeah.
Okay. Ready?
I've got Nick from Sloan. He says, tax lady, my employer dropped health insurance because of the cost. We are now getting it through the marketplace. We are paying around $650 a month out of pocket. Can I use the premiums as part of my medical expenses on the Schedule A? And so the answer is yes, you
If
can.
he's paying them.
But yes, potentially use it. But don't forget, there's all these caveats. And the first one is you have to be an itemizer. And then your medical expenses have to be greater than 10% of your adjusted gross income. Anything that slides over into that field of greater than 10%, then that is a potential allowable write-off for you. So, and as Esther
And
says,
if you're getting any subsidies, it's not what the bill is, it's what you're actually paying.
right, as Esther says, that's right, what you're actually paying. So you want to keep that in mind. And for instance, also if you got braces for your kids, all of that adds up to the potential medical write-off. So you want to keep track of your copays for your medicine, your drugs, things like that. And
Your deductible,
yeah.
right?
Yep, your
Yeah.
deductible,
Some of these deductibles are humdingers.
yeah,
your mileage going back and forth to the pharmacy,
Yep.
going to the doctors, going.
get long-term care insurance. You can write that off.
Right.
Yep.
Yep.
So there's a lot in there, and if you are paying the $650 a month, that's $650 times 12 is $6,500 plus another 13. You're looking almost $8,000 you paid in taxes. So if you're
Medical.
in medical, so then if you're making $50,000, you're already over the 10% floor. So it's worth the time to get everything else that you spent money on for medical.
I'll tell you, if you just get in the habit of saving your receipts, and you don't have to do it on a contemporaneous basis, you don't have to add them up each month, just save them so that at the end, and do it at the end of the year, so you at least have the proof. Because and people will say, oh, well, is it really worth my time? It is, because if you are an itemizer and you're over by $5,000, for instance, and you're in the 15% bracket, you just saved yourself $650 plus New York State.
Right. So definitely, Nick, save everything and,
Right.
Run the number. Give us a call. We'll run the numbers for you.
Right.
And don't forget, if you ever have any life events or if your income changes, you have to go back into that exchange and adjust and tweak. And so there goes back to that computer stuff again. You really have to stay on top of
And
things.
2015 is the last year for someone over 65
To get
where
the
it's only the
reduced floor.
7.5% floor. So seniors next year is going to be 10%.
Right. In other words, it's going to be harder to claim the deduction.
Yes.
Right?
For everybody. That's right.
Okay. But again, especially for seniors or people approaching, looking at nursing home insurance is also a medical deduction on the federal and a credit on New York State.
Yep.
Right.
20% credit.
Right. Okay. What else?
I
you
got Emma. from North Tonawanda. Esther, my mom is 80 years old. I was told she didn't have to file because of her age, but yet her sister still files and she's 85. I must be missing something. Is there another factor involved?
Yup. It's called income. If your taxable income's low enough, then when you compare it against your standard deduction and personal exemption and the little extra standard deduction you get for being over 65, if your taxable income is underneath that threshold, you don't have to file.
Right.
And some people are only filing because they have withholding, like on their pension. Stop the withholding on your pension. If you're under those thresholds, you don't have to file a tax return.
That's right.
And I have to tell you, some people, I'll have seniors that'll come in and I'll say, you don't have to file anymore. And they're sad. I don't have to file? Nope, you really don't have to file. But don't I need it for my STAR program? If the city says you do, but I think that you just have to bring your Social Security statement, and you don't even need it.
Yes.
But yeah, so if your standard deduction plus your over 65 exemption plus your personal exemption,
it's about $11,000.
right, added together, if your taxable income is under that, and that doesn't count your Social Security,
That's what I was just going to say.
then you don't have to file.
Yeah. So, Emma, I'm thinking your aunt, your mom's sister, either has more income than your mom, or your aunt does what Esther says. She doesn't really have to file, but she has withholdings and she files. There's a lot of different variables as to why your aunt's filing. And then also you want to think about, well, maybe your mom should have been filing, and so you want to just give us a buzz.
Well, you would know if your mom should have been filing because they usually write you the love letter.
That's true.
Where is your tax return? So,
Takes them a little while.
and if you are somebody that hasn't filed and they haven't written you, sometimes that means that you have a refund coming and they're not going to let you know, and after 3 years you lose the refund. So
It happens. I still remember I had a guy lose $40,000
It sticks
because he
in
didn't
your
file.
because he didn't file.
Yep. Well, it's interesting because it just very well could be that her sister, the only reason she's filing is to get a refund back.
Mm-hmm.
And that's another thing. If you're a senior and you don't have any tax liability and you're under those filing thresholds, and for a married couple it's almost $20,000, $21,000, you're having maybe $1,500 withheld out of your pension, if you stop the withholding, you won't have to file anymore. And it gives you an extra X amount of dollars a month to live on, too. So it's something to think of. And again, if you're not sure, you can call EG Tax, give us your numbers, and we'll tell you if you can stop your withholding.
That's right.
Okay? Yeah. What else we got here?
I've got
Darlene writes in, I just started a small business. I have a dog grooming business. Do I need to charge sales tax? Is there anything else I need to know?
You just helped somebody. You just helped somebody the other day with sales.
I did, and they did not know. And he had no clue on sales. I'm a general contractor. I know how to build. I know how to plumb. I know how to do electric. Numbers is not my game.
Right.
And he proved it in the sales tax because he did it wrong for years.
Right.
And New York State came in and said, "You're wrong. Here you go. Here's your bill," and they killed him. And luckily, he came into us. We reopened it and we fought it and we won, and we got the balance due now down to zero. Because we were able to prove he paid sales tax on his materials, that a lot of his stuff was capital improvements that wasn't subject to sales tax. So,
but Darlene here, she has a dog grooming business. That's a horse of a different. There are no capital improvements on doggies, but you do have to charge sales tax on your services. So the first thing you want to do, Darlene, is you got to start today, starting to charge sales tax after you call New York State and tell them you need a sales tax number. They're going to give you a sales tax certificate that authorizes you to collect sales tax for the state of New York. All right? Yep. That's number one. Number two, you have to timely file your sales tax report quarterly. And the New York State is very unusual. Instead of doing January, February, March, April, May, June, July, August, September, they don't do it that way. Their year is December, January, February, March, April, May. So it's just completely bizarre. Do you know why they do it that way?
No.
And then also I just want to chime in and say, That's another automated thing, is that you have to go online to
file your
NewYorkState.gov and you have to make an account and you have to file your sales tax online.
So, Darlene, you owe the sales tax even on the items you did not collect. All right, so that's number one. You're going to have to pay out of your own pocket. Number two, get your sales tax license. Number three, you should look for liability insurance, because if people are coming in, dogs are with other dogs, somebody could bite somebody, you want to make sure you get liability insurance.